Good evening, students. Good evening, sir.
Ma'am.
Sir, students, this is your LVC session and this is your exclusive problem solving session, which will be taken by sir. So in this, sir will take the questions and MCQ from the capital gain and other sources. And if you have any doubt for any other heads of income or for any other topic which already you have been learned in this LVC, you can ask the query. But before sir will take the session, I just want to take a case scenario based question because you have covered many provision, basic concept, residential status, your 5 heads of income, your major chunk has been already covered. So I want to take one RTP question, RTP of May 25 RTP question, and I want all of you to participate in solving this question because it is a revision for all the topics which you have covered so far. So it's your revision, ki how much you understand and what are the areas which you can miss out in the examination and what are the crucial point you have to keep in mind by solving any question. So what can be tricky points can be there in solving the question or the case scenarios. Okay, students, so are we ready? Because all of you have to participate. I will ask the provisions directly. I will not jump to the MCQs answer. I will ask the provisions from you. Ki what are the relevant provisions and then what is the applicable provisions in this case. So then we will drive the answer ki what is the correct answer of the particular MCQs. So I'm just starting reading with the case scenario. Mr. Raj, aged 38 years, an Indian citizen, is carrying on manufacturing business in Canada. He frequently visits India for business purpose on a regular basis. He was in India for the first time in the previous year 21-22 for 190 days. Then he visited 2022-23 for 145 days and then in the year 23-24 for 155 days. Afterwards, he decided to close his business in India and shift permanently in India. So he came to India on 1st November 2024 and started a business in Mumbai. So from this information, you all must have known that residential status definitely will come into picture. When the person is residing outside India or going outside India, then definitely it will give an impact on the residential status because you have on the basis of residential status only you have to determine his scope of total income. Then only taxability under which head, what are the amounts, what are the applicable tax rate, all that will come. So from this information, it should be keeping come on your mind that residential status we are going to determine in this question, in this case scenario. His profits from business is Canada till 31st October 2024 is 15 lakh and from Indian business is 5 lakhs. He does not own any house property in Mumbai and staying in a rented accommodation from 1st November 2024 on a monthly rent of 20,000. Then he made a donation of 50,000 to PM Cares Fund and a donation of 20,000 to Prime Minister Drought Relief Fund by check during the previous year 24-25. This paragraph, students, because deductions from gross total income is not covered yet in LVC, this part you can skip for this class. Once the deduction chapter you completed, then you can try to solve the particular MCQ related to this question, this facts. So I'm just skipping this part for solving the case scenario and I will skip the MCQ also related to this fact. He had purchased 10,009% debentures of ABC Private Limited in August 2020 at 1 rupees 50 per share per debenture. Face value of each debenture is 100. He sold 2,500 debenture in April 24 at the rate 175 each. Then remaining 7,500 debenture in August 2024 at 155 each. Interest on debenture is due on 30th November and 31st December. Then CII is given. So first question is what is the residential status of Mr. Raj for the previous year 24-25? So student, first tell me in this what Mr. Raj is an Indian citizen and he is visiting India. So what will be the basic condition that would be applicable on an individual who is an Indian citizen and who is visiting India. What are the basic conditions applicable to him for becoming a resident in India? Student, you can raise your hands also. I will give you an option to unmute yourself if you don't, because writing somehow is not possible to write all the condition and everything. So you can raise your hand, give a chance to unmute yourself and to speak. But as I said, please participate because this is revision for all the topic or most of the topics which we have already covered in the LVC. So don't hesitate. Tanu is saying staying in India at least 182 days. Any other condition also, Tanu? I'm not talking about abhi now this fact. I'm just asking when an individual who is an Indian citizen who resides in abroad and comes in India on a visit, then what are the basic conditions that is applicable to that individual for becoming a resident in India? Rajveer is saying 182 days and 365 days for 4 years. Staying in India for more than 182 days, only first basic condition needs to be checked. Staying in India for ठीक है, Indian citizen who visits will be resident 182 days or more. 182 days.
Hello.
Yes, yes.
Good evening, ma'am.
Good evening.
मैम बेसिक कंडीशन बताना है ना?
हाँ बिल्कुल.
Can I speak Hindi?
Yeah, sure. But try to speak in English. It's for your betterment. But in the class, you can speak in Hindi also. I will translate in English for the other students for understanding their understanding.
Yes, ma'am. Yes, ma'am. Okay. And less than 182 days in India in previous year, or less than 60 days in India previous year, plus 365 days in 4 preceding previous year.
Your name is Shagufta, right?
Yes. Yes, ma'am.
Shagufta, you are telling for becoming a resident or for becoming a non-resident?
Non-resident, ma'am.
Okay. ठीक है. So firstly, I'll just take it as a resident. So you are telling कि one of the condition is 182 days or more, and the second condition?
Second condition, non-resident, ma'am, na?
Okay, non-resident. You tell them about non-resident. I will convert it into a resident because you should know both. मतलब, if you are saying less than 180 days for non-resident, so it means 182 days or more for resident.
Oh, अच्छा मैम.
तो आप non-resident की बताइए. I will convert it into a resident.
Okay, ma'am. Less than 60 days in previous year, or plus 365 days in previous year, four preceding previous year.
Okay.
Non-resident का.
ठीक है शगुफ्ता. Tanu, you have also raised your hand. So
Good evening, ma'am.
good evening. So your answer is same or different?
No, ma'am. In case Indian citizen who visited in India, तो उसके लिए 182 days का उसे कंपल्सरी स्टे इन इंडिया होना चाहिए, तभी वो रेसिडेंट होगा, अदरवाइज वो नॉन रेसिडेंट होगा.
ठीक. Most okay Tanu. Most of the student has answered one first condition 182 days or more. That is very much right. The first of the basic condition is the individual should be resident in India 182 days or more for becoming a resident in India. But I'll just keep aside this fact. I asked if an individual who is an Indian citizen who visits India, then what are the basic conditions? First condition everybody is aware of. Second condition is also there. What is the second condition? Second condition depends upon one thing. What is the one thing? That how much total income he has from Indian business, Indian sources. Or you can say in your study material, what language we have used, total income other than income from foreign sources. So this is also important for another condition. So if this total income from Indian source does not exceed 15 lakhs, then definitely only and only this condition will be applicable for an individual to become a resident in India. But if this total income from foreign sources exceeds rupees 15 lakhs, then there is one more condition that you have to be checked. And what is the second condition? In that second condition, this 60 days has been replaced with 120 days. So in that second condition, in the second case, the individual will be a resident either because of 182 days condition or because of 120 days in the relevant previous year plus 365 days or more in preceding 4 years. Got it, students? But in this, there is one catch also. What is the catch? If an individual who is an Indian citizen who visits India, but in our case, what is the situation? He has closed his business in India and he shifts permanently in India. If the person is permanently with the intention of permanently shifting in India, if he's coming, then he will not classify as a visit in India. Then that condition would not be, that exemption that would not be applicable to that assessee. So what will happen if an individual who is a resident in India who is staying abroad, he is coming to a visit to meet his parents or for any business purpose or something for some time, then in that case he will be a resident in India for if he will be resident in India if he stayed for 182 days or more, or if his total income exceeds 15 lakh from Indian sources, then 120 plus 365 days. But because he is shifting India permanently, this 120 plus 365 days ka condition ka benefit that would not be applicable, and the basic two condition, that is 60 days or more plus 365 days or more in the preceding 4 years, that would be applicable in our case to Mr. Raj. Got it, student? Tanu, it's 365 days in preceding 4 years, not 5 years. So in case of Mr. Raj, he would be resident in India either if he stayed in India for 182 days or more in the relevant previous year, which is previous year 24-25, or he would be resident in India if he stayed in India during the previous year 24-25 for 60 days or more and plus 365 days or more in the preceding 4 years. Is it clear, student? Why these two conditions, 182 days plus 60 plus 365 days, we need to check for Mr. Raj. So in the previous year 24-25, if we see, he came to India on 1st November and he has not again went to abroad. So from 1st November 24 to 31st March 25, he is in India. The number of days are 151. So it means first condition, because of first condition, he is not resident in India. We have to go to the second condition. Second condition says 60 days or more in relevant previous year, which he satisfy, but plus you have to see 365 days or more in the immediately for preceding year. So in our case, what is our relevant previous year is 24-25. So we have to check go preceding 4 years to 23-24, 22-23, 21-22 and 2021. In this 4 years, he has to be in India for 365 days or more. So we have to see whether this condition is also satisfied or not, because 60 plus 365 days is a cumulative condition. Individual has to satisfy both the condition to become a resident in India. In our case 21-22 में for 190 days, 22-23 में 140 days, and 23-24 में he is staying for 150 days. So the total he stayed in how much days? 490 days. Yes. So it means what? It means he has satisfied this condition, second basic condition, 60 days plus 365 days. So he is a what? He is a resident in India. Is it clear, student? Then we have to see what? He is a RNOR or ROR. These things we have to see. They are, if any of the one condition, these are the two conditions. For being an ROR, both the conditions should satisfy, but for being a RNOR, any one of the condition is satisfied, he will become a RNOR. What are the two conditions? If he stayed in India for 729 days or less in immediately preceding 7 years, or he is a non-resident in 9 out of 10 years. So in this case, if we see the first condition, 729 days or less in 7 years, he visited first time in India on 21-22. And we have already calculated for 90 days he has stayed in the 4 preceding years. So in the 7 immediately preceding years also he has stayed for 490 days, which is less than 729 days. So he is what? He is RNOR. Clear? So what is the answer of the first MCQ? A. Mr. Raj is a resident but not ordinary resident in India for previous year 2024-25. Any doubt, student, in the first MCQ? Because now the second MCQ will be on capital gain, will be on the amendment, then definitely there will be tricky points also. Chauhan, you can remember 730 days or more or 2 out of 10, but these conditions are for ROR. And these both conditions should cumulatively satisfy for any individual to become a ROR. But in case of RNOR, any one of the condition, if he satisfied, he will become an RNOR. Either way you can remember, but remember both the things, when to satisfy both, when to satisfy anyone. Anil ma'am, we need not check additional condition for person in case he falls under exceeds 15 lakh, right? Yes, if total income from Indian sources exceed 15 lakh and he has stayed for 120 days or more and 365 days or more in the preceding 4 years, and because of that he is becoming a resident, then directly he will be a RNOR. You don't need to check the these other conditions for becoming a RNOR or ROR. He will directly be a RNOR. Anil, I have, because in my case, I have not applied the 15 lakh provision because visiting India concept is not applicable in this case because he is permanently shifting to India. He is not falling under that exception. There are 3 exceptions. One exception is regarding the person who is going abroad for the purpose of employment. Second one is as a member of crew. And the third one is regarding the person who is coming on a visit in India. But in our case, since he is permanently shifting to India, he will not fall under any exception. So the two basic condition, 182 days or more, 60 plus 365 days, the simple two basic condition we need to check to become a resident in India. And in that case, additional condition you have to check. Only visit, total income exceeding 15 lakh, comes on a visit in India, then only you have to see 120 plus 365, the modified condition. Is it clear, students, now? So next question is regarding what is the capital amount of capital gain chargeable to tax in the hands of Mr. Raj on sale of debenture for previous year 24-25. So if we go to the fact, this paragraph relates to the capital gain part. He has 10,000 debentures, so we have to bifurcate this 10,000 into two parts because he sold initially 2,500 debenture, then 7,500 debenture. So firstly, tell me about this 2,500 debenture. He purchased in when? Purchased in August 2020. Okay. Now sold it in April 24. What is the period of holding? What is the period of holding for debentures which are unlisted because it's a private company? So what is the period of holding for unlisted debentures to classify as a short-term capital asset or as a long-term capital asset? What are the period of holdings? Come on, students. Tanu said less than 12 months. So you are telling ki 12 months. Farhan is saying 2 years. Anil is saying more than 12 months treated as long term. Any? Okay, 12 months के लिए student just revise your concept. First, I'm just again telling it's a unlisted debenture. Yes, Harshda said correctly. It's 36 months. Because first you have to see this transfer took place before 23rd July. If you see before 23rd July, there was 3 period of holding: 12 months, 24 months, and 36 months. In case of unlisted securities other than share, the period of holding is 36 months. Look, this is your chapter. This is a summary also. I'll just revise the summary. See, in case of transfer took place before 23rd July, for unlisted securities other than shares, these are debentures. For that, the period of holding is 36 months. So if it's less than or equal to 36 months, it's a short term. If it is more than 36 months, it's a long term capital asset. Okay, so in our case, it's more than 36 months, so it will be a long term capital asset. Long term capital asset mein, what is the sale consideration? Sale consideration is your 2,500 debenture into 175. So sale consideration will be 437500. Now, what is the cost of acquisition? Just tell me, do we need to give the indexation benefit to Mr. Raj? Because it's a long-term capital asset, and on long-term capital asset, which is transferred before 23rd July, indexation benefit you can give. Because on or after 23rd July, indexation benefit is not permissible, but before it is permissible. Yes, Ishan, very good, Jayant. Indexation benefit is not available on the debentures and bonds. Since it's a debenture, there will be no indexation benefit, and the cost of acquisition, which is 2,500 into 150, that we have to reduce it from sale consideration to drive the long-term capital gain, which is 62,500. Very good, Tanu. Now we are coming to the second point regarding the debentures, which is transferred on in August 2024. These are purchased again August 20 में, sold August 24 में. So this will be the long-term capital asset, right, student? Because 36 months से ज़्यादा it has been hold, so definitely it will be a long-term capital asset, right? है ना, student? Yes, Jayant. Very good, Chauhan. Very good, Farhan. Because it has been transferred on or after 23rd July 24, the transfer of debenture which has been taken after this date will be always short-term capital asset, and there is no question of we have to see the period of holding. There will be always short-term capital asset. So what is the sale of consideration? 7,500 into sold at 155. 1162,500, and your cost of acquisition is 7,500 into 150, which comes to 11,25,000, and the remaining is your short-term capital gain, which is 37,500. So your correct answer will be D. Got it, student? Long-term capital gain 62,500 and short-term capital gain 37,500. Simple. Now what will be the GTI? GTI में first thing capital gain will be of 1 lakh. That is already we have computed. 62,500 your long term and 37,500 short term. Then what are the other income? Other income, there is this income also regarding your profit from Canadian business in Canada and profit from business in India. So do I need to add both the income? Both the income will be taxable in the hands of Mr. Raj, or only 15 lakh or only 5 lakh? Which business income will be taxable in the hands of Mr. Raj in India? Farhan said both. Soumya said 5 lakh. Anil said only Indian income. If you see, student, what the RSSC, Mr. Raj is an RNOR. In case of RNOR, only income which is received in India, deemed to received in India, accrue arise in India, or deemed to accrue arise in India, or the income which is derived from a business or profession which is set up in India is taxable. But in our case, this third point regarding the profit from the business set up in India, that is not in our case, in case of Canada business, because his main business was in Canada and now he has shifted to India. So, and it is not accrued arise in India. So this 15 lakh would not be taxable in India in the hands of Mr. Raj because it's not accrue arise in India. So only this 5 lakh, which is an Indian business income, that would be taxable in the hands of Mr. Raj. So is it this student, or there is one more income? Only these two? Or yes, Ishan, very good, very good. There is one line also regarding the interest on debenture. Rate is also given 9% on the debenture. So we have to calculate the interest on debenture also. How do we calculate? The information is given that interest on debenture is due on 30th June and 31st December. So what is the meaning of this, student? What is the meaning of due on 30th June? Because student, there's a difference between something when the income is accrue or when the income is due. When income is due, then it gives you a right to claim that income. Accrue means ki it income is accrued because the services or something which we have been already done, but you don't have the right to claim that income at that point of time. Suppose I say about salary. Your salary is for per month. Your salary is due on the last day of the month, but when you do work for the 1 day, your salary accrues for the 1 day, but it will due only on the end of the month when you can claim the right to your employer for the salary. You can't say ki 1 month I have done the work for 1 day, so just give me the salary for 1 day. You have to wait for the month when your salary becomes due and you can claim the right on the salary. However, it accrues on the daily. Similarly, for interest, day by day interest is calculated for all day on the number of days, but you can't claim the interest on day wise. So for that, interest will be due in case of this debenture on 30th June when you have a right to claim the debenture, or when the company will give you the debenture, interest on debenture, and 31st December. These two are the date when the company gives you the interest. Mr. Raj follows cash basis of accounting. This is also very important in this case. Why is this important? If you see these first, when will be the last interest received by the Mr. Raj? If we are in the previous year 24-25, last interest will be given by the company on 31st December 2024. Now when the 23. Now when the next interest will be due and will be receivable in the hands of Mr. Raj, that will be on 30th June 2024. Mr. Raj follow cash basis of accounting. It means on the 31st March, he is not accruing basis pay 3 months ka interest. He is not deeming as income and paying tax on that. On 30th June, when he receive for all the 6 month interest, then he will offer this to tax. So in this case, what is important? The dates are important. First interest he receivable on 30th June and the second on 30th December 2024 in our relevant previous year, which is 24-25. But when we have to, what we have to see on 30th June, how much debenture he holds that point of time. Because only on that debenture company will pay the interest to him. He has already sold 2500 debenture in April 2024. So when on the date of 30th June, when the interest is due, only 7500 debenture is with Mr. Raj. So he will receive interest on these debenture at 9% into 100 face value years and for 6 months, because last interest was paid on 31st December. So only 6 month interest he will be received. So it will be 33750. Yes, Tanu. Okay, that interest. Then this is the interest. And what about on 31st December? How much interest will he receive on 31st December 2024? No interest, because no debenture. Because all debentures he has sold on in April and August. So there is no debenture in December. So there will be no interest. So the gross total income of Mr. Raj will be 6,33,750. So your correct answer is B. Is it okay? Any doubt? Okay, everyone has a right 633,750. Very good. This fourth MCQ, as I told, I am skipping this because this is on the deduction part. So I'm just telling you what is the correct option so that we can move to the next answer, next MCQ for the tax liability. The correct answer in this case is 85. So the deductions you have to give to it of 85,000. Your GTI is what? GTI is 6,33,750. So what will the total income? 548,750. So we have to compute the tax liability of Mr. Raj. Mr. Raj के लिए information is given कि he has opted out of the default tax regime. So we have to compute the tax liability as per the normal provisions of the act. ठीक है student, just calculate the tax liability. This consists of 3 parts of your income. One is your interest income, second is your LTCG, and third is your STCG, and fourth is your PGBP income. These 4 are the components of this 5,48,750. Just compute the tax liability as per normal provisions of the act. I can help you in the bifurcation also. 85 k deductions, definitely it cannot be from the LTCG. So we can exclude it. Suppose I am assuming कि this 85 k deduction I giving against the PGBP income. Or do I need to bifurcate it? Special rate ki income, what are the special rates income in this 4 component? LTCG and STCG also, na students? Special rates income? Yes, Chauhan said LTCG and STCG, 2 are the special rates income. Soumya said yes. Anil said interest as well. Why, Anil, why interest special rates will be applicable on interest part? Why? Whosoever is saying no, no, please correct me. What are you saying? No about interest or no about LTCG or STCG? In these four components, special rate would be applicable on which component of income? Got it, Anil? For interest, slab rate will be applicable. For BGBP, slab rate will be applicable. Now, special rate is applicable on LTCG and STCG, right? Yes, Tanu, very good. This STCG is not, special rates is not applicable on STCG. Why? Because this STCG pertains to the debenture which is transferred on or after 23rd July 2024, and in that case, on the sale of debentures, on the transfer of debenture, of the redemption of debenture, they will be always short-term capital gain, and for short-term capital gain, only special rates are given under section 111A, which is for units of equity share, units of business trust, or equity-oriented fund. There is no other special rates for short-term capital gain on any other asset. Only on these three assets, special rates are there for short-term capital gain. And it's a debenture, unlisted debenture, so there is no special rate. So this STCG will be taxable at a slab rate. Now, computation is simple. If you have understood this, you can compute the tax liability. Okay, so फटाफट we'll just do the computation for the tax liability. LTCG was 62,500. And what is the rate for LTCG? On unlisted debenture. Come on, student. Tanu, keep in mind this LTCG is for the debenture which has been sold before 23rd July. So this 12.5% rate is for on or after 23rd July. This is the crucial year, students, because definitely different rates, different period of holding, all these are falling in 24-25 only. And in your examination, you have to remember whether it's a pre-scenario or post-scenario, what are the pre-condition, post-condition, you have to be aware of both the scenarios. Yes, Tanu, it's at 20%. So it will be 12,500. And on other income, remaining income, that is your 4,86,250. Slab rate will be there. Slab rate may your basic exemption limit of 2,50,000. Remaining will be taxable at 5%, which is 11,813. So plus 12,500 into your education cess, it comes to 25,285, and by rounding off it is 25,290. So your correct answer is A. Clear, student? Is this in this case scenario, student, we have covered your residential determination of residential status, your scope of total income, your capital gain, other sources, plus your tax rates, which is in the basic concept and in the computation also. So 4-5 provisions we have dealt with in the one case scenario. So that is why case scenarios are very important, because it's a integrated of many things, and you have to cumulatively apply all the provisions in the one particular question and scenario. Johan, for see your total income is this 5,48,750. So your long-term capital gain is 62,500. So the remaining income is 4,86,250. Only slab rate you have to apply on that. Basic exemption limit is what? 2,50,000, because he's not a senior citizen or something, and he's under the normal provisions of the act. So you have to reduce 2,50,000, and on the balance it will be 5%. Clear? So with this, students, I am just now handing over the session to Ankit sir. He will take the further questions for capital gain and other sources. If you have any doubt in this case scenario or something, you may please ask. Otherwise, I'll just hand it over to Ankit sir. Over to you, sir.
Okay, ma'am. Thank you so much, ma'am. Good evening, students. So that was a very good question taken up by ma'am, and that must have remind you the old provisions of basic concept, residential status, rates of taxes, and then income from other sources provisions. Capital gain also was there. So that must be a kind of a journey, whatever you have gone through till now. So because you have completed your 5 heads of income completely, and ma'am has explained it very beautifully and very clearly every provision to you. So you can see the faculties, your coordinators, your BOS faculty, those are really working hard for you that you can achieve the goal of your life to become a CA as soon as possible. So today we will be discussing a lot of problems test your knowledge questions of income from other source, test your knowledge questions of capital gain, some new examples of capital gain I am going to discuss with you, and a lot of MCQs also. So we will discuss it one by one. Let me see if there is any query. So there was a query from Mr. Chauhan. Page. He was asking, good evening, sir. My doubt in section 54 that other condition income from such house should be chargeable under income from house property. So he wants to know what is the meaning of this condition. So Mr. Chauhan, in case of section 54, you have to transfer a residential house to claiming the exemption, and then you have to invest in a new residential house. So the house you are transferring, that should not be your business asset. That should be a house which is included under your income from house property head. Because if there is any building which has been included under your business head, like a stock in trade, etc., or a capital asset. So if you transfer that factory building, if you transfer your stock in trade, you are not eligible to claim section 54 exemption. So that is for your personal use. And if any house property is it for your personal purpose, that is going to be included under income from house property. Whether it is rented, whether it is self-occupied, it does not matter. But the primary condition, the house you are transferring should be assessed under your income from house property head. Only in that scenario, you are able to claim exemption under section 54. Okay. Before 23rd of July 24, LTCG 112A, Mr. Jayendra is asking, 4 lakh after 23rd of July, long term is 5 lakh. Exemption is in aggregate, Mr. Jayendra. You can claim 1,25,000 exemption in aggregate. So your total capital gain is suppose 9 lakh rupees under section 112A, whether it's before, some part and after. Even you can claim maximum 1,25,000 exemption out of those 9 lakh rupees. Okay. Astha is saying, ma'am, in case of employment going abroad, it will cover both self-employment and when his employee sending abroad as shifting him in another branch. So if there's an intention of permanent shifting, so if that is a part of your visa, that if somebody is going to be shifted for employment purpose on a temporary basis, then in that case, that exception would not be applicable. So there would be a permanent condition that such employee is going to be transferred permanently. So if the intention, if the condition is for shifting that employees outside India as permanent, then only that exception will be triggered. Okay. Sir, in 54D, even taken on lease will be covered. Section 54D, it says you have to purchase that property. So there should be a registry in your name, whether via lease, etc. So lease are also two kinds of lease, like financing lease and operating lease. But we have to see that the ownership of that property should be transferred to the buyer. Only in that case, it will be assumed as purchase. So we have to see, as per terms and condition, there should be a lease. If there is a lease, that is generally does not include as a part of your ownership, because that is for a certain time period. So there should not be any certain time period. It should be kind of a ownership in your hand. So we have to see as per the fact of the case. But rate difference is there, so you can deduct 1,25,000 from earlier. If it is possible, then the rate would be lower on that part. So it is beneficial to an assessee that you can exempt that 1,25,000 from that capital gain which has arisen on or before 27th of July, 27 July 2024, because in that case the rate was higher. So you would be in a beneficial position. So as such, there is no bifurcation, as such, there is no direction issued by the government. So you can take the benefit of 1,25,000 from your earlier capital gain. Rate difference is there, okay? Asta is saying, sir, if going for self-employment, yes, exactly, the self-employment, if you want to start your business also outside India, so you have to take a visa. In that visa, it must be specified that your returning date is not sure, because you are going permanently outside India. So that is the condition, that if it is permanent situation to going outside India, that would be considered as an exception, okay? In note written, asset is used by assessee for the national undertaking belonging to him, even if he is not owner, means on lease he has asset. No, is not written the note that he is not the owner. If look, there are certain lease which is for more than 50 years, 60 years, 90 years. In that situation also, you are treated as the owner of that property. So a lot of places, whether we reside or we are having our shops, etc., is from government or some society. But in that situation, the lease period is 50 year, etc. So you must have gone through under income from house property also. If there is a lease period is more than 12 years, then you are treated as the deemed owner also. So according to it, if that is considered as the deemed owner, then in that case, you can take the exemption. Okay. So I have, when the question was discussed by the ma'am, there was one student, I guess named Shagufta was there. And I was listening her answer. So Shagufta, are you here this time? I want to clarify one thing to you that may be very important in your examination also. So even if you are not there, let me tell you one thing, very interesting thing for your examination purpose. And I will explain that in Hindi because she was answering in Hindi. तो शगुफ्ता को जब मैम ने पूछा था कि आप ये पर्सन रेजिडेंट है या नॉन रेजिडेंट, तो उसकी कंडीशन क्या है बेसिक. सो शगुफ्ता सेड कि अगर वो 60 डेज से कम होगा तो नॉन रेजिडेंट होगा, और अगर लास्ट 4 इयर्स में 365 डेज से कम होगा तो नॉन रेजिडेंट होगा. और फर्स्ट कंडीशन शी सेड कि अगर वो 182 डेज से कम होगा तो नॉन रेजिडेंट होगा. तो वो शगुफ्ता करेक्ट है आपके पार्ट पर, आपने जो बोला है उसका इंटरप्रिटेशन से आपका आंसर तो ठीक आएगा. बट अगर एग्जाम में क्वेश्चन आता है और पूछता है व्हाट आर द बेसिक कंडीशन फॉर बिकमिंग अ रेजिडेंट इन इंडिया, तो आप उसे ऐसे एक्सप्लेन करके नहीं आ सकते कि 60 डेज से कम वाला नॉन रेजिडेंट है और जो ये पूरी नहीं करेगा वो रेजिडेंट है. सो एक्ट में ऐसा डिफाइन नहीं है. सो एक्ट ने डिफाइन किया है रेजिडेंट क्या होता है. That if you are in India for more than equal to 182 days in the previous year, or you are in India for more than or equal to 60 days in previous year and more than equal to 365 days in 4 preceding previous year, then you can be treated as a resident if exceptions are not applicable. And if you are not able to, अगर आप ये दो कंडीशन पूरी नहीं कर सकते हैं, नहीं कर रहे हैं, तो आप नॉन रेजिडेंट बोले जाएंगे. तो आप उसे ऐसे एक्सप्लेन नहीं करके आ सकते रिवर्स साइड से कि 60 से नीचे वाला और 365 से नीचे वाला नॉन रेजिडेंट है और जो ये पूरी नहीं करेगा वो रेजिडेंट है. सो प्लीज कीप इट इन माइंड कि एक्ट में ऐसी सिचुएशन डिफाइन नहीं है. क्वेश्चन आपका उससे शायद सही सॉल्व हो सकता है, बट प्लीज जो एक्ट में जिस तरह से प्रोविजन को एक्सप्लेन किया गया है, आप प्लीज उसको उसी तरह से समझिए. ओके. Lease can be maximum for 99 years. Yes, Mr. Chauhan. Jayendra is asking if land and building transfer before 23rd of July 2024, then indexation shown before capital gain. If after, then not shown in capital gain, correct. Before 23rd July, part of GTI. After 23rd July 24, not part of GTI. Absolutely correct, Mr. Jain. You are absolutely right. If there is a long-term capital gain before 23rd of July, then we will show indexation and we will calculate tax according to indexation concept. But if it is a case of on or after 23rd of July, in case of individual HUF, those are resident, and only in case of immovable property, then we cannot show the indexation concept in GTI format. For GTI purpose, we will always show without indexation calculation, and for the purpose of tax calculation, then we will see the both kind of calculation. We will solve that kind of question in today's class. Okay. 54F1A, the cost of the new asset is not less than the net consideration in respect of original asset. The whole of such capital gain shall not be chargeable under section 45. In this case, cost of new asset exceed 10 crore, then what happen? We will take the maximum value 10 crore rupees for the purpose of investment. When you will follow that formula, original capital gain upon net sale consideration multiply by the investment amount. And suppose you have purchased a new asset for 12 crore rupees, then you multiply with maximum 10 crore rupees. And I guess that kind of scenario has been explained in the notes also. And I have asked you to do the homework of section 54F question. And you can see there are multiple provision has been given in which this situation has been discussed. STC in case of non-resident and foreign company not covered under section 111A. What is the tax treatment? We have gone through with the notes in which we have discussed the rate in this scenario also. So I can show you the concept if you want to see the rate of taxes we have discussed in this situation. Your query was regarding non-resident and foreign company. So I guess you did not go through with this concept. So here is the provision. If that is before 23rd of July, there are separate provision for non-resident and foreign company, 10%. And if it is on or after 23rd of July, the rate would be changed and that would be 12.5%. Okay. Astha, I have uploaded the chart of cost of acquisition earlier, and I have also shared the MCQ. I guess yesterday I have uploaded all the MCQ of capital gain, and the chart also has been uploaded earlier. Okay. So now we are going to discuss some questions of test your knowledge. First of all, from income from other source concept. Jayendra asking in buyback indexation benefit is available or not? How it would be available? In case of buyback, the income you will receive as a shareholder on or after 1st October, that would be your income from other source. In case of capital gain calculation, the cost will be taken as nil. The sale consideration would be nil and whatever cost you have paid, that would be there. So if it is on or after 1st October, there is no indexation concept applicable. In case of shares, you know that only indexation benefit is for immovable property. So we have discussed the test your knowledge question number 1 from income from other source in the last class. The remaining question regarding test your knowledge in case of income from other source, now we are discussing one by one. So that will, I guess, help you to understand the provision more clearly. Okay. I believe you must have gone through with all the provisions of income from other source, capital gain, the old provisions of basic concept, house property, etc. So we have covered all the illustration in the last class and test your knowledge question number 1. So after that, now we are discussing test your knowledge question number 2, and we are not discussing technically. I'm going to ask you also, so that would be an interactive session. So I can see what you are going through in these last days when you have time to revise these topics. And let me tell you very interesting questions of capital gain we are also going to discuss. So first example of income from other source from test your knowledge, we have already gone through. Now question number 2. The question asks, examine whether the following are chargeable to tax and the amount liable to tax. So a sum of 1,20,000 was received as gift. A sum of 1,20,000 received as gift. from non-relative by Raj on the occasion of the marriage of his son Praveen. So whether it's going to be taxable or exempted, students. Tanu is saying, sir, if in question not given in which regime to solve question, then in which regime we should to solve question. I believe, Tanu, when an examiner is going to make a question for this kind of examination like ICAI or CA examination, so he must have kept in mind in this kind of question. So either there would be a specific provision that you have to solve with regime or by both regime. If the question does not say so, I don't know. I guess you should follow the both regime and the most beneficial tax should be your answer. So for that purpose, you can send a mail to the BOS also. So they would give you the exact answer upon what should be done in this case of scenario. Okay. So the answers are here. And Ishan is saying taxable. Well done. Jayendra is saying taxable, taxable, wholly taxable. Tanu is saying taxable. Nidhi is saying exempted. Very good. Astha is saying exempted as on marriage, even received from non-relative. Very good, Astha. Mohammad Farhan is saying exempted. Taxable, sir. Soumya is saying not liable to exempt. Not liable to tax. Okay. Who is saying this? Johan. And Harshada is saying taxable, taxable, taxable. Okay. So, gift if received on marriage of your marriage, then it's going to be exempted. So, the following chargeable to tax liability has been asked, and a sum of 120 was received from a non-relative by Raj. So, who is the receiver? Raj is the receiver. So, is the marriage belongs to Mr. Raj? No, the marriage is of his son Praveen. So marriage of his son Praveen. So if Praveen has been received 120, that would have been exempted, but he did not receive the amount. Who received the amount? Raj. And it is not the marriage of Mr. Raj. So that is going to be 100% taxable. Astha and etc. Those have said that this should be exempted. Please kept in your mind that the marriage depends upon the person who is getting married. If he or she received the gift from relative or non-relative, exemption would be there. Not in this case. Now, interest on enhanced compensation of 96,000 received on 12th March 25 for acquisition of urban land on which 40% relates to 23-24. So out of this 96,000, 40% relates to the preceding year, but you have received that 40% also in current previous year, that is 24-25. So how much is going to be taxed in our previous year? 24-25. What amount we are going to tax in previous year 24-25? Mohammad Farhan is saying, but Raj will give to his son Praveen. How you are sure about this, that Raj will give to his son Praveen? So you are assuming condition of with an examination question that it will happen. So you can imagine like this also, what if Mr. Raj has been died? So that kind of assumption you cannot take. So we have to answer whatever whosoever received that compensation or that gift or that amount, we have to give the answer according to that situation. We cannot add our assumption, Mr. Farhan. Okay. Jendra is saying 48,000 taxable. Tanu is saying full amount. There is 50% benefit, Tanu. We have discussed that also in capital gain and income from other source also. If there is interest on enhanced compensation or original compensation received, so it is going to be taxed in the year in which it received, and 50% is going to be taxed under income from other source. So the correct answer is, of course, 48,000. Taxable. Clear? Now the question number 3, it's again regarding the enhanced compensation interest, and it's very, very simple. It says on 10th October 2024, Mr. Govind, a bank employee, received 50,000 towards interest on enhanced compensation from state government in respect of compulsory acquisition of his land effected during the financial year 16-17. So he received 1,50,000 of interest relates to financial year 17-18. Clear? Then he also received 1,65,000, which was connected to previous year 18-19. Then he also received 1,85,000 from the financial year it is connected with 1920. So total whatever 5 lakh rupees he received, those belong to these years. And he incurred 50,000 rupees as legal expenditure. So how does it matter? The provisions are very simple. If you receive any interest on EC or OC, then in the year of receipt, the 50% is going to be taxed and the 50% is going to be exempted. And the taxability will be under income from other source. So out of these 5 lakh rupees, 2,50,000 is going to be taxed under income from other source. As simple as that. Okay. Moving on to question number 4. The following details have been furnished by Mrs. Hemali. It's a very interesting question. Pertaining to the year ended on 31st March 2025. Cash gift of 51,000 received from her friend on the occasion of her Shasti Patha Purti, a wedding function celebrated on her husband completing 60 years of age. This was also her 25th wedding anniversary. So what should be the treatment of this 51,000? Whether it should be taxable or exempted, depending upon the condition. Ishan is saying taxable, Julie is saying taxable, because the amount has been exceeding 50,000. And again, this was her 25th wedding anniversary or the 60 years of completion of her husband. How does it makes a difference? So this is going to be taxable 51,000. The third point is very interesting. Okay. Second point. On the above occasion, a diamond necklace worth rupees 2 lakh was presented by her sister living in Dubai. So whether this 2 lakh is going to be taxable or exempted. Tanu is saying exempted. Chauhan Tej is saying 2 lakh exempted. Nidhi is saying taxable. Harsh Kaur is saying taxable. Because why it should be taxable, Harsh Kaur or Nidhi? You can see it has been received from her sister. And if any gift has been received from relative on any occasion or even without occasion, so gift from relatives are always exempted. Any gift other than relative is exempted if it is on the occasion of marriage. So we have gone through with these kind of provision. So you should see the asset and who is actually giving you that gift. And because sister has given this gift, so in that situation, that would be 100% exempted. Now the question is there, question number 3, situation number 3, for what I was waiting. When she celebrated her daughter's wedding, so still we are talking about Mrs. Emily, okay? So when she celebrated her daughter's wedding on 21st February 2025, her friend assigned in Mrs. Hemali's favor a fixed deposit held by the said friend in a scheduled bank. The value of the fixed deposit and the accrued interest on the said date was 52,000 rupees. Now, this is very interesting question. Whether this 52,000 is going to be taxable or not. So, in your opinion, what is the correct answer? Do we need to tax 52,000 or not? Ishan is saying taxable. Tanu is saying taxable. Pooja is saying exempted. Almas is saying taxable. Nidhi is saying taxable. Okay. Chauhan Tej Prakash is saying taxable. Anubhav is saying taxable. Shailesh Kumar, everybody, almost everyone has said this is going to be taxed. Only I guess one student was saying exempted. Everyone else was saying it is taxable. Okay, Miss P is saying 50% taxable. Okay, a new answer I got. Miss Nissi is saying also taxable. So the first thing in case of gift, I have asked you multiple times. The first thing in case of gift, I asked you what we should check. The first thing, what is the first thing we have to check when there is a gift provision? What I have asked you to check initially in case of gift provision, the very first thing you have to check before the taxability and amount, what that should be. Monetary or non-monetary. Very correct, Soumya. Or we can say which kind of asset you received. So we are talking about the FD, fixed deposit receipt. So the friend gave her fixed deposit receipt, FDRs. You must know what the meaning of FDRs, Stefan. So does FDR fall in the monetary category or non-monetary category? Monetary category means cash, check, IMPS, etc. FDR's kind of a certificate. So is that kind of certificate? It's a certificate of deposit. So is that kind of certificate will fall in the definition of monetary or non-monetary? So that has not been defined. We don't have any specific provision for that. So in this situation, you have to give your two answers because in the definition we have considered monetary, and in case of non-monetary, there are no asset which include this kind of non-monetary asset, FDRs. So if we treat it a monetary asset, that FDR is equivalent to monetary, then that is going to be taxed. Of course, it's going to be taxed. Completely, it's going to be taxed. Or if it is a kind of a security, we assume it, then it's going to be taxed in a non-monetary item. But if we do not consider it as a monetary or non-monetary because not specifically included under income from other source section 56 to 10. So in that situation, that could be exempted also. So if you'll go through the answer of this question number 3, so it has been specifically said that there is no specific heading which include this kind of asset for the purpose of taxability under monetary or non-monetary. So we have to give the both answer. If it is considered as asset monetary or non-monetary, that is going to be taxed. And if it is not considered as monetary or non-monetary, as not specifically included under the provision, then in that situation, that would be treated as non-taxable. So you can go through the question number 4 detail answer. You can see the provision says any sum of money, etc. received. Point number 3 we have to see. And you can say what the study says. The study says to be exempt from applicability of section 56 to 10, the property should be received on the occasion of the marriage, etc. Therefore, this exemption is not attracted because there is no marriage. But the different scenario arises. Any sum of money received without consideration by an individual is chargeable to tax under section 56 to 10. If the aggregate value exceeds 50,000 in a year, a sum of money, however, not defined under section 56 to 10. So the sum of money word has not been defined. Therefore, there are two possible views in respect of value of FD assigned in favor of Mrs. Hemali. The first view is that the FD does not fall within the meaning of sum of money. And therefore, the provision of section 56 to 10 are not attracted. So that amount is not going to be included for your income from other source. And if it is included as sum of money, then that is going to be taxed under income from other source. Okay. You can go through this in detail. Now we are moving on to our 5th question. Examine the following transaction. Examine the following transaction. Mr. B transferred 500 shares of RP Limited to Messrs. B Company Private Limited on 10th October 2024 for 3 lakh rupees, where the fair market value was 5 lakh. The index cost of acquisition of shares of for Mr. B was computed at 4,45,000. The transfer was not subject to security transaction tax. So the provision says what would be the treatment of this situation? The provision says we have to see what should be done in the hands of Mr. B. The transfer has been done on 10th October 2024. That means on or after 23rd of July. So indexation concept not applicable. So you can see in case of Mr. B, there would be sale consideration 5 lakh as per section 50 CA. We have discussed in case of unlisted shares, if that has been transferred and the FMV is higher than the consideration, then FMV will be treated as your sales consideration as per section 50 CA. We have gone through with this provision under capital gain. Then index cost of acquisition has been given, and that is 4,45,000. So there would be long-term capital gain of 55,000. Now this 5 lakh rupees shares has been received by Messrs. B Company Private Limited for 3 lakh rupees. So there would be a 2 lakh rupees inadequate consideration case applicable. That is going to be treated as Messrs. B Company Private Limited income from other source and going to be taxed in this scenario. The provision says, second point, Mr. Shazin is employed in a company with taxable salary amount of 5 lakh. He received a sum of 1 lakh from Atma Charitable Trust registered under section 12B by account paid check in December 2024 for meeting his medical expenditure. Is it going to be taxed or not? So we have gone through the provision of this concept also under income from other source. What would be the correct answer, students? थर्ड का आंसर क्या होगा सर? निधि आस्किंग क्वेश्चन नंबर 4 के थर्ड पॉइंट का आंसर पूछ रही हैं आप निधि, उसका बताना है. 2 lakh tax in Messrs. B and Company Private Limited. चौहान निधि पूछ रही है थर्ड वाले का आंसर. निधि जो क्वेश्चन नंबर 4 का थर्ड पॉइंट था वो हमने डिस्कस करा अभी कि अगर एफडीआर को मॉनेटरी माना जाएगा तो उस केस में उस पर टैक्स लगेगा, और अगर इसको मॉनेटरी नहीं माना गया तो फिर इस पर टैक्स नहीं लगेगा. दोनों सिचुएशन आपको एग्जाम में डिफाइन करके आनी है ऐसी सिचुएशन में. फाइन. Chauhan is asking only 2 lakh, so what about 3 lakh? Mr. Chauhan, I guess you did not take the last class of our last session of income from other source in which we have discussed these kind of concept. I guess it's first session of income from other source. So for if you receive any asset, in this example, if you receive shares, those market values are 5 lakh rupees and you have paid only 3 lakh for that. So 2 lakh would be your income from other sources. 3 lakh would be your cost of acquisition in this case. That is the amount of expenditure you have done. So that could not be treated as your income. So 3 lakh rupees you paid, we are discussing what should be your income. So whatever amount you received as a gift, that would be treated as your income. Okay. So what would be the correct answer of this point, students? That is going to be exempted because there is an exemption concept in this case. If you received gift from any charitable trust, those are registered under section 12AB. You can go through with the exemption part in which we have discussed that gift from relative is exempted, gift from via will exempted, on contemplation of death is exempted. In those scenario, you can see there is a concept which say if you received a gift from a trust which is approved under section 12AB, then that amount of gift is also exempted in the hands of receiver. Okay. Now we are going to discuss test your knowledge questions of capital gain. Tax rate chart now. And there are very, very interesting question under test your knowledge from capital gain topic. So that is, we are going to discuss one by one. And after that, we are having multiple MCQ questions of income from other source also. So test your knowledge question of capital gain. First question says, read the question very carefully. The question says, Mr. Mithun purchased 100 equity shares of MS Good Money Company Limited. Just a second, let me download the Word file so you would be able to understand it. This is moving on to test your knowledge questions from capital gain topic. In the case of capital gain, I have told you earlier also, you will see that the questions are really huge, but the solution is very easy. We just need to find out the relevant information to solve the question accordingly. And if you are able to find out the information what we need for a question, definitely you are able to solve that question very, very easily. So the question is here, and the question says, Mr. Mithun purchased 100 equity shares of Messrs. Good Money Company Limited on 1st April 2007. So whatever we have purchased 100 equity shares. And the date is very relevant. In this year, this is your previous year 24-25. For this year, the date of capital gain is very, very important, utmost important. Because you are having buyback amendment in the mid of the year till 30th September, the provisions are different, and after that it changed. And the 23rd of July, you must know. So the provisions are very, very different before that date and after that date. So to solve a question of capital gain, you have to see very carefully what is the date of transfer also. The purchase date is 1st April 2007. The purchase value is 1,000 rupees per share in public issue of the company by paying the security transaction tax. So we have paid security transaction tax at the time of purchase. Company allotted bonus shares in the ratio of 1:1 on 1st December 2023. He also received dividend of 10 rupees per share on 1st May 2024. He has sold all the shares on 1st October 2024 at the rate of 4,000 per share through a recognized stock exchange and paid brokerage of 1% and security transaction tax of 0.02%. So you can see he has transferred normal shares and bonus shares both on 1st October 2024. So indexation concept has gone. And you can see on purchase of these shares and sale of these shares, STT has been paid. So section 112A provision or section 111A provision could be applied. Okay, we will see that. Now, what is the requirement of a question? The question is asking us to calculate his total income and tax liability. Both we need to calculate. If Mr. Mithun pays tax under default tax regime, okay, section 115 BAC. Assuming that he is having other income also worth rupees 8 lakh. The fair market value 31st January 2018 is 2,000. You can see a numerical question. They actually give you a lot of hint. Some students think theoretical questions are easy and numericals are different. But in my opinion, numerical questions gives you hints themselves. Like you can see in this question, the question is actually talking to you and it is saying that we have paid security transaction tax on purchase and on sale also. And why this FMV has been given for 31st January 2018? Is it trying to explain something? Is it trying to give you a hint that look, in this question 31st January 2018 FMV has been given? Why they are giving this kind of FMV? What is the utilization of FMV on 31st January 2018? We have gone through with the provisions. So can you tell me what is the use of providing the FMV on 31st January 2018? Very good, Ishan. Of course, yes. To find out the cost of acquisition. In case of section 112A, where securities has been allotted to you or purchased by you on or before 1st February 2018, and if STT has been paid at the time of purchase and sale of those equity shares, etc., then we have to calculate cost of acquisition with a specific provision. So for that purpose, we need 31st January 18 FMV. So you can see a question try to always explain that, look, I am telling you these information and you have to find out what is the implication. So we have to solve this question. So you have seen we are having two kinds of shares, normal equity shares and bonus shares also. How many equity shares we were having? 100 equity shares, and of course 100 bonus shares we are having. The purchase date of equity shares, the original equity shares was 1st April 2007. And the bonus share allotment was 1st December 2023. And these has been transferred on 1st October 2024. So you can see this will fall under long-term capital asset, and because this is less than 12 months, so that would be fall short-term capital asset. So the basic condition I have written over here, then I'm going to solve it on a separate sheet so you can see that clearly what and how we are going to solve this kind of question. So the original shares, after solving this question, I will give you a break, students, and that was bonus shares. So we have discussed that would be long-term capital asset. This is your short-term capital asset. Clear? We are having 100 equity share. We are having 100 bonus shares. And each share has been transferred at the rate 4,000 each. So because the asset has been transferred on 1st October 2024, now the sale consideration for these 100 original equity share would be 4 lakh. The expenses on transfer has been given in the question. That is 4,000. It has been mentioned in the question. So my net sale consideration would be 3,96,000. But now these shares, because they does fall under section 112A. So for the purpose of cost of acquisition, because they does fall under section 112A, so no indexation can be done. So for the purpose of cost of acquisition, we are having special provision. How we will find out our cost of acquisition? First is actual cost of acquisition. The actual purchase price was, we have purchased 100 share for 1 lakh rupees. And now we have to compare this value with lower of FMV on 31st January, which has been given 2,000. So for 100 shares, it would be 2 lakh, or the sale consideration, which has been given 4 lakh. Whichever is lower, we need to take. So that 2 lakh would be my lower value. And now from these two values, higher would be my cost of acquisition. So 2 lakh is going to be my cost of acquisition in this case. So the value of long term would be 1,96,000. Clear, students? Now for bonus share also, the sale consideration would remain the same, 4,000 per share. Again, expenses on transfer would remain the same, 4,000, and net sale consideration is same. Now, can you tell me what should be the cost of acquisition in this case? According to this special provision, as we find out the cost of acquisition of these shares, what would be the cost of acquisition in case of bonus shares? Who is going to tell me? Almas is saying nil, Harshada is saying nil, Pooja is saying, why it's nil? If you will follow the provision as we have done in case of original equity shares, actual consideration would be nil. But there would be FMV and there is a sale consideration also. So in that situation, if you will try to find out the cost of acquisition like this, there would be a cost of acquisition. Why you are saying nil? What is the reason why you are saying nil? If you calculate it, yes, Julie, if it is allotted after 1/4/2001, so we have to find it like this. Actual cost of acquisition would be nil. Now we have to compare it. FMV would be 2 lakh and sale consideration would still be 4 lakh. So lower would be 2 lakh. And from nil or 2 lakh, we need to take the higher. So higher would be 2 lakh. So why are you saying it should be nil? What is the reason? Then you are calling it should be nil. What is the reason behind it? There would be a cost of acquisition of 2 lakh according to the provision if we are going to apply the provision as we applicable for original equity shares. So what is the reason that you are saying nil? If you are saying because it is after 1st April 2001, no. Due to it is after 1st April 2001, so we have taken this value nil. But if you have to follow this concept, there would be 2 lakh rupees cost of acquisition. Astha is saying after 23rd July it is nil. Where is this provision? Yes, the first and correct answer has now come, and that is Mr. Chauhan is saying. Tanu is saying, Harshada, find it out. It is short-term capital asset. The special cost of acquisition is applicable when section 112A is applicable. And in this situation, this is short-term capital asset. So because it is a short-term capital asset, this special provision for finding out the cost of acquisition does not apply. It is not because it is on or after 1/4/2001. We are not applying this concept because this is a short-term capital asset. Suppose if it is a long-term capital asset, bonus share has been allotted. If it is allotted before, suppose in year 2021, then the cost would be 2 lakh over here. Got it? So now the short-term capital gain, 3,96,000. So these are very minute things, but you have to kept in your mind because a silly mistake would definitely going to reduce your marks a lot. So that was calculation of capital gain. Now we are going to find out the tax and our GTI. The other income in the question has been 8 lakh rupees. So for the purpose of GTI, the GTI would be 8 lakh and 2,000 rupees dividend also there, 10 rupees dividend. So total shares are 2,000. So after including dividend under income from other source and other income 8 lakh and your capital gain, your GTI would be 1394000. Clear? So now for the purpose of tax calculation, I have to separate this GTI into separate part as we have shown in earlier capital gain provision. So there is long-term capital gain under section 112 is here and the value is 1,96,000. Out of this, you must have remembered that 1,25,000 is exempt. So the remaining balance is 71,000 for the purpose of taxability. Then we are having short-term capital gain under section 111A, and that is 3,96,000. And then other income, which is 8,02,000. we have to follow the default tax regime. So according to default tax regime, we will apply that slab rate that up to 3 lakh rupees it's nil. The remaining 4 lakh is going to be charged at 5% and the balance is going to be with 10%. So the tax on this would be 30,200. What is the tax rate we need to apply in 111A? What is the tax rate we need to apply in case of 111A? Yes, Chauhan, very good. It's 20% we have to apply. Why 20%? Because it's on or after 23rd of July. If it is before 23rd of July, the rate would be 15%. So now 396 is there. The tax would be 79,200. And on this value, the rate would be 12.5%. So the tax would be 8875. If you will aggregate it, the tax liability would be 118275. Rebate is not applicable because it's exceeding 7 lakh rupees. No surcharge because not exceeding 50 lakh rupees. Cess we need to apply 4%, 4731 and 123006. After rounding off 123010 would be your answer. Clear? So this is a kind of question that is like examination kind of question. It is not an easy question what we have gone through. So you have need to understand that if this kind of question comes in examination, there would be multiple provisions are there, but you have to keep in your mind the date of sale, the date of purchase, what asset we are transferring, the nature of gain, short term, long term, etc. Okay. Okay. Done. So now I guess we should take a short break, and then when we will resume, we will continue our test your knowledge question of capital gain. So Mr. Manish, can we go for a short break? Welcome back, everyone. So we were discussing the test your knowledge questions of capital gain. We have gone through with question number 1. Moving on to the second one. So in case of capital gain, it's very, very important to read the question correctly and find out your components. Like you have to write it down in some place that these informations are very important to solve a question. Once you have gathered the important information, you are able to solve that question very easily. Like the question number 2. Okay, Arav convert his plot of land. Now you can see the question explains you what to do. He convert his plot of land. So what provision is going to be applicable in this case? You can think about it. Purchased in July 2004 for 80,000 into stock in trade on 31st March 2024. So I believe that you must have understand that what kind of provision is going to be applicable in this case. The provisions of conversion of capital stock, conversion of capital asset into stock. Section 45(2) is going to be applicable. So when you find it out that in a specific question, some provision has been directly applicable, then you have to focus on the provision of that concept only. There is no other information, there is no other concept is going to be applicable, only a single asset which has been converted into stock in trade. The fair market value as on 31st March 24 was 3 lakh. And the stock in trade was sold for 3,25,000 in the month of January 2025. Find out taxable income, if any, and if so, under which head of income and for which assessment year. So in case of conversion of capital asset into stock in trade, the year of taxability would be the year in which stock in trade has been sold. So because the stock in trade has been transferred in January 2025, that means the assessment year of taxability would be 25-26. Very simple. So the capital is going to be taxed in assessment year 25-26 and the PGBP also. We already have gone with this provision that conversion is equivalent to transfer. So the transfer has taken place at a time of conversion on 31st March 2024. That means previous year 23-24. Transfer has been done in 23-24, but we will charge that in assessment year 25-26 at a time when that stock in trade has been sold. So for the purpose of period of holding, the time duration would be count from July 24 till March 24. So that would be long-term capital asset. First thing, the sale consideration. So the provision says the sale consideration is the FMV at the time of conversion. So the FMV at the time of conversion has been 3 lakh rupees. That would be treated as sale consideration. Now, index cost of acquisition. Index cost of acquisition. Now you can see the stock has been transferred in January 2025. And should we go for indexation of this cost of acquisition, even if the asset has been transferred on or after 23rd of July 2024 or not? So indexation would be done or not? What would be the correct answer? Should we apply indexation in this case or not? Because that asset has been sold, the stock has been sold in January 2025. Indexation applied even if the amount has been received on or after 23rd July 24. Reason, the transfer has been done on 31st March 2024. So this is the only chargeability year, not the real transfer. The real transfer of capital asset has been done in March 2024. So we will apply the indexation concept on it. So the cost of acquisition has been given in the question 80,000. Index of previous year 23-24 need to be applied, and that would be 348 and divided by 113. So our index cost of acquisition would be, after doing that, 246,372. Simple question. You can reduce it from sale consideration and balance would be your long-term capital gain. There would be PGBP income also, and that would be 25,000 because the sale price of this stock and the FMV on conversion date would be treated as purchase price. So the balance would be your PGBP income, and that is going to be taxed accordingly. So that question number 2 was very simple. We have already solved these kind of question, but question number 3 is interesting. Now you can see Mrs. Harshita purchased a land at a cost of 35 lakh in financial year 2004-5 and held the same as her capital asset till 20th March 2024. She started a real estate business on 21st March 2024 and converted the land into stock in trade of her business on the said date, when the fair market value of the land was 210 lakh. So the transfer has taken place on 21st March 2024. That means previous year 23-24. But asset did not sold it. It had just converted. So we will charge this capital gain, again a section 45(2) case, in the year in which stock is going to be sold. Now the new thing is this. On that plot of land, she constructed 15 flats of equal size, quality, dimension. Cost of construction of each flat is 10 lakh. Construction was completed in February 2025. She sold 10 flats at 30 lakh rupees per flat in March 2025. The remaining 5 flats were held in stock as on 31st March 2025. So there might be a question in your mind that the cost of construction, that is kind of cost of improvement on land, she has done construction of 10 lakh rupees. So can you tell me this cost of construction can be treated as cost of improvement under capital gain or not? Correct. If it is after conversion, so that would form part of your PGBP expenditure. It won't be treated as your capital gain cost of improvement. Very well done said. So let me show you how to solve this question. So assessment year 25-26. First of all, we are calculating capital gain, the sale consideration. The provision says the sale consideration would be taken as FMV at the date of transfer. So 210 lakh was the FMV, and we have only transferred 10 flats. Out of 15 flats, we have only sold 10 flats. So we are going to calculate capital gain only on 10 flats. The remaining 5 flats are still stock in trade. So capital gain would be chargeable to tax in the year in which those flats are going to be transferred. So we are going to find out the capital gain and business income only on those flats which has been sold. So the 210 was the FMV of full 15 flats. So for the purpose of 10 flats, the sale consideration need to be taken as 140 lakh. Now let's index cost of acquisition. So the purchase price of land was 35 lakh, which is for 15 flats. So for the purpose of 10 flats, the value is going to be 23.33. And this need to be indexed 348 upon 113. So my index cost of acquisition of these 10 flats would be 71.85 lakh, 86. Then my long-term capital gain would be 68.14 lakh. What is my PGBP income in this case? So the sale consideration, the sale price was 300 lakh for these 10 plates. So the cost for these 10 plates, whatever has been taken as sale consideration, in case of capital gain is going to be your purchase price over here. That would be 140. So 60 lakh would be my business income. Clear? But the question does not end here. There's one more information which has been given in this question regarding the investment purpose. The provision says she invested 50 lakhs in bond issued by National Highway Authority of India on 31st March 25 and another 50 lakh in bonds of Rural Electrification Corporation Limited in April 2025. So which bond she can claim exemption and how much exemption she can claim? Are these both bonds are eligible for the purpose of exemption? The NHAI and RECL both are eligible and you have to purchase within 6 months from the date of transfer. So she has purchased within 6 months from the date of transfer. You can see February 2025, she has transferred this property, construction complete, and March 25, she has sold 10 plates. So within 6 months from the date of transfer, you have to purchase, and she has invested 100 lakh rupees in this case. But as per section 54 EC, we can claim maximum 50 lakh rupees exemption under section 54 EC. So due to that, we can only exempt 50 lakh rupees and remaining 18 lakh and 14,000 is going to be taxed as your long-term capital gain under Capital Gain Act. The balance is going to be your PGBP income. Well done. Yes, all answers are correct. Very well done. Now question number 4 is here. Again, this is also regarding conversion of capital asset into stock in trade, but it is having some very interesting thing, a different kind of question. It is not conversion case, it's a destruction case. Okay. So question 4 is saying, so it says Mr. A is an individual carrying on business. His stock and machinery were damaged and destroyed in a fire accident, which occurred in December 2024. So stock has been destroyed. That is a part of your PGBP. The treatment would be under PGBP. Clear? And machinery as a depreciable asset. So in case of depreciable asset, PGBP and capital gain, both scenarios are there and we have to see which is going to be applicable. In case of depreciable asset, what's the treatment for PGBP? That is regarding depreciation we have to see. And in case of capital gain, if it has been transferred, then we have to see whether it could be capital gain or loss depending upon the situations. So whether destruction has been included under the definition of transfer or not. We have gone through with the definition of transfer also. So is destruction has been included under the definition of transfer under section 247 or not? Chauhan is saying yes, Anubhav is saying yes, Ishan is also saying correct, very good. Yes, it is a relinquishment. But destruction is going to be treated as transfer only in one case. What is that case? When we can consider destruction of an asset as a transfer. When? Yes, if insured asset. If the insurance has been taken, very well done said Tanu, Ishan, Jayend. If that is insured asset, then on the destruction, we can claim the capital gain or capital loss as the case may be. Fine. So now you can see the provision says the value of stock lost damage was 6,50,000. So because we are talking about stock, so that means PGBP case we are talking about. In case of PGBP, if there is a loss, the loss need to be shown at debit side. So 650 is the loss, value of loss. Certain portion of the machinery could be salvaged. So we are talking about asset. The opening balance of the block as on 1st April 2024. That is WDV on 31st March 24 after providing depreciation for previous year was 10,80,000. Okay. So we have taken opening WDV of the asset. It has been given 10,80,000. That is for depreciation purpose. So we are considering till now the PGBP concept regarding that asset and stock both. So for the purpose of stock, the amount of value of lost stock we have claimed in debit. And for the purpose of depreciation, I have written the opening WDV of the asset. Now, during the process of safeguarding machinery and in the firefighting operation, Mr. A lost his gold chain also. Oh my God, disaster ho gaya idhar. Fine. So he lost his gold chain also. So gold chain is a capital asset, of course, jewelry, etc. And a diamond ring. Loss he lost, which he had purchased in April 2005 for 1,20,000. The market value of these two items at the date of accident was given 1,80,000. So now we have to do the treatment for stock and then machine and now for gold chain and diamond also. Now the information said that Mr. A received the following amounts from the insurance company. So all these assets are insured. Towards loss of stock, we have received 4,80,000. So I will write it down at the credit side like 4,80,000. Remaining would be your business loss. Now towards damage of machinery, he received 6 lakh rupees. So for the purpose of calculation of depreciation, I have to reduce this value from the opening WDV. That is money receipt. So remaining is 4,80,000. So we can claim depreciation on that in two situations. For the purpose of claiming depreciation, there must be two conditions which should be fulfilled. First one, there should be asset in the block and there should be value in the block. So value do exist, but there was a single machinery in the block and it has been destroyed. So in this example, there is no machinery left. There is no asset left in the block of asset. So we cannot claim the depreciation. So in case of machinery, we cannot claim the depreciation. Only stock case, we can have a loss of 650 against which we have received 480. So balance would be your business loss. But in case of capital asset, that is our machinery depreciable asset, PGBP has no treatment for it because there could not be any depreciation claim. But under capital gain, now we will see whether we will have any treatment or not. In case of depreciable asset, we will take the sale consideration, 6 lakh. And we are going to reduce opening WDV of the block of asset. Opening WDV of the block of asset, and that was 10,80,000. So now we are having 4,80,000 short-term capital loss. So in case of depreciable, we can claim short-term capital loss of 4,80,000. No depreciation in PGBP, but there would be a capital loss of 4,80,000 because whole block of asset has ceased to exist. So stock treatment we have done, machinery treatment we have done. Now about gold chain and diamond ring. So for the purpose of gold chain and diamond ring, we are having our sale consideration of 1,80,000. It's a long-term capital asset because purchased in 2005. Now you can see the cost of acquisition has been given 1,20,000. Do we need to do the indexation or not? Do we need to do the indexation or not? The asset has been destroyed in December 2024. That means the transfer has been done on or after 23rd of July 2024. And because it has been after 23rd July 24, there would not be any indexation. So this would be your cost and 60,000 would be your long-term capital gain in this scenario. I hope it's clear now. So we are having a treatment of gold chain and diamond ring also. Not short term, it's long term because purchased in April 2005 and we have transferred in due to destruction or lost. It is in 2024 December. That's why we are not going to do indexation in this case. I hope it's clear now. Chalo, question number 5 पे आते हैं, ठीक है? Question number 5 is regarding that section 50C provision. You have to find out the stamp duty value, etc. concept. So in case of land and building, we have gone through with the provision of section 50C, which says which stamp duty value which should take for calculating or for the purpose of calculation of sale consideration in case of capital gain. So the question says Mr. Sarthak entered into an agreement with Mr. Jaikumar to sell his residential house located at Kanpur on 16th August 2024 for 1 crore 50 lakh rupees. So this is called consideration, actual consideration. Okay? The sale proceed were to be paid in the following manner. 20% through account pay bank draft on the date of agreement, 60% date of possession, balance after completion. So because payment has been transferred at the time of agreement via account pay check. So that means the stamp duty value we need to take on 16th August 2024. It has been done on or after 23rd of July. Remember this, okay? Now, Mr. Jaikumar was handed over the possession of the property on 15 December 24 and the registration process was completed on 14th January 25. He paid the proceed as per the sale agreement. The value determined by the stamp duty authority on 16th August, 15th December, 14th January. So only this is relevant for us because the stamp duty value on the date of agreement will be considered as per section 50C if any amount has been transferred by account, pay, check, etc. Clear? So sale consideration would be find out according to this. So you can see the consideration decided 1 crore 50 lakh and the stamp duty value is 1 crore 70 lakh. And as per section 50C, if the SDV exceeding 110% of consideration, then sale consideration would be your stamp duty value. So consideration is 1 crore 50 lakh. 110% of 1 crore 50 lakh would be 1 crore 65 lakh. So stamp duty value is 170, which is exceeding 1 crore 65 lakh. So this kind of question, we have multiple question we have solved like this. So in that case, sale consideration in this question would be 1 crore 70 lakh. Clear? Sarthak had acquired the residential house at Kanpur on 1st April 2001 for 30 lakh rupees. Clear? After recovering the sale proceed from Jaikumar, he purchased two residential house property, one in Kanpur for 20 lakh and another in Delhi for 35 lakh on 28th May 2025. So you have to calculate the income chargeable under the head capital gain. So let me ask you a very interesting question. In this scenario, do we need to find the cost of acquisition for the purpose of capital gain, or we should only consider the cost of acquisition? So indexation we need to do or not? You have the question in front of you. You have the requirement of question in front of you that what we need to calculate, what should be my answer. So do we need to apply the indexation concept or not in this scenario? Mr. Anil is asking, sir, could you please repeat machinery calculation? Mr. Anil, we are on YouTube. You can scroll back that provision and you will be able to understand what exactly I have taught students. If you have any issue in that calculation that you are not able to understand the depreciation part or the capital gain part, then you let me know. I will explain it again. Okay. Somebody is saying indexation needed. Anil is saying indexation needed. Nidhi is saying no. Rajveer is saying no. Soumya is saying no. Exactly. The correct answer, we do not need indexation because the asset has been transferred after 23rd July 2024. So there would not be any indexation requirement. So the cost of acquisition 30 lakh need to be reduced directly. So after that, my long-term capital gain would be 1 crore 40 lakh. Clear, students? Now you will see he has purchased 2 properties to claim exemptions. 2 residential house within time. The time period for purchase, in this case, section 54 is applicable. Because we have transferred our residential house and we are going to purchase another residential house. And if my capital gain does not exceed 2 crore rupees, then we can take the benefit of 2 houses. And you can see in this question, the capital gain does not exceed 2 crore rupees. So we can take the benefit of both houses if that has been purchased within time. So one has been purchased 20 lakh rupees on 24th March 2025 and one has been purchased in 28th May 2025. That means before due date of ROI, that is 31st of July 25 at least. So because the investment has been made before that, so we can claim the exemption of both houses with this. So after that, my long-term capital gain would be 85 lakh rupees. In this question, if the tax has been asked to calculate, that please calculate the tax also. Then we can do that indexation concept for the purpose of taxability. Because in that case, the taxability need to be calculated by indexation and tax rate 20%, and without indexation, tax rate 12.5%, as we are going to do that in question number 7. Ishan is saying, Ishan is saying, sir, it's for individual and it's immobile property. So we to do indexation only at the time of tax purpose after 23rd of July. Absolutely. For the purpose of calculating GTI, or if the question is only asking to calculate you the capital gain or GTI, then you do not need to apply indexation. Ask you that need to calculate tax, then for the purpose of GTI, we will not show that calculation, but for the purpose of tax calculation, we are going to apply that indexation concept. We will see that kind of question in question number 7. Jayendra is saying ITR due date extended, then due date for investment in CGAS extended applicable for your examination. Yes, it is not applicable for your September examination because the amendment which has been come before 6 months is going to be applicable. And this amendment has been come within that 6 months. So generally, it is not going to be applicable. You have to solve question by taking the date as 31st of July. Even do one thing, you can raise this query. You should send this email to the BOS and they will definitely going to give you a correct answer upon this thing. Okay. Next is question number 6. In question number 6, before that, solving this question number 6, let me solve question number 7, because this is again like question number 5. The same concept is here. But question number 7 is a question for what we are looking for to make you understand that what and how we need to calculate the capital gain without indexation. And if the question asks for calculation of tax, then how we need to show that calculation later on with indexation. So So it's a very interesting question. The question says Mr. Shiva purchased a house property on February 15, 1979. Okay. For 3,24,000. So if there is a purchase which is before 1st April 2001, so there must have been a FMV that must be given the question on 1st April 2001. In addition, he has also paid stamp duty 10% on the stamp value of 3,50,000. So at that day, the stamp duty value was 350 and the purchase price has been 3,24,000. Okay. In April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and received an amount of 1,11,000 as advance. So again, the question is trying to explain you. The question is trying to give you hint that there is an advance payment. So there must be advance forfeiture about to come. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance in May 2015. So this advance money has been forfeited before old provision. So this advance money forfeiture 1,11,000 has been done in April 2008. So technically this is going to reduced from your cost of acquisition because it has been done before 31st March 2014. However, the sale consideration did not materialize. Okay. In May 15, so here is the advance money forfeiture in 2008 for rupees 111,000. So this is going to affect your capital gain provision when the property is going to be transferred from cost of acquisition. This amount is going to be reduced. So this is going to have your treatment under capital gain. In 2015, he again entered into an agreement for the said house for 20,25,000 to Mrs. Deepshikha and received 151 as advance. However, as Deepshikha did not pay the balance amount, Mr. Shiva forfeited the advance. In August 15, Mr. Shiva constructed the first floor by incurring a cost of 390. So he forfeited the amount from Miss Deepshikha also, and that has been done in 2015, May 15. So this is going to be your income from other source. This has not going to be treated in your capital gain, and that has been the income of May 15-16 previous year. So 1,51,000 is going to be taxed under income from other source. Clear? In August 15, this is your cost of improvement. 3,90,000 your cost of improvement in August 2015. So you can see in this paragraph, there were 2 advance money forfeited and 1 cost of improvement information was there. Out of that, this is not going to affect my solution in assessment year 25-26 because that has been taxed, already taxed in previous year 15-16. That means assessment year 16-17. This is going to affect my capital gain. This is going to affect my capital gain. On November 15-24 again, Mr. Shiva entered into an agreement with Mr. Manish for sale of such house or for 30,50,000 and received an advance of 150 as account paid check. That means stamp duty value need to be taken on 15th November 2024 because there's an agreement and there is an account paid check is there. Manish paid the balance entire sum and Mr. Shiva transferred the house to Mr. Manish on February 2025. Shiva paid the brokerage of 1% on sale consideration. So this is my expenses on sale. On 1st April 2001, you can see the fair market value is there now. FMV of the house was 11,85,000 and stamp duty value was 10,70,000. So you must have remembered, but there was a concept that in case of immobile property, if it has been purchased before 1st April 2001, we need to take the FMV as your cost, but that FMV cannot exceed the stamp duty value, or we can say we need to take the cost as per FMV or stamp duty value if given, whichever is lower. So FMV is 1185, but the stamp duty value is 1070. So that means my cost would be 10,70,000. Further, the valuation as per stamp duty authority for such house on 15th November 24, on the day we have taken the advance money, was 39 lakh, and on 20th February it is 41 lakh rupees. You can see the consideration for this house has been decided 30 lakh 50,000. 30 lakh 50,000. So consideration for sale was 30 lakh 50,000. And the stamp duty value we need to consider 39 lakh. Now, as per section 50C again, if the stamp duty value exceed 110% of your cost, the sale consideration would be your stamp duty value. In this case, stamp duty value exceed the 110% of cost. So my sale consideration is going to be 39 lakh. Okay. Compute the capital gain in the hands of Mr. Shiva. Okay. Also compute tax liability under section 112. Assuming that basic exemption limit has been fully exhausted against other income. So you should assume that the exemption limit is no more. You have to calculate the tax only on assuming that you are having capital gain income and you cannot claim the basic exemption limit. So now let me show you the solution of this question. Okay. So we were having the information, and because the asset has been transferred on or after 23rd of July 2024. So assessment year 25-26. The period of holding will make this asset a long-term capital asset. Now the sale consideration, you have seen that the sale consideration would be 39 lakh rupees. As the stamp duty value exceed 110% of consideration. 1% was the brokerage, and brokerage was on consideration. So consideration decided 30 lakh 50,000. So the 1% brokerage also need to be calculated on the consideration, not on the stamp duty value. That would be 30,500. Now my net sale consideration will be the remaining value, and now I am going to reduce the cost of acquisition because it is on or after 23rd of July. So indexation would not apply, and the cost was 10,70,000. As per the provision, because the stamp duty value is lower than the FMV on 1st April 2001. So that would be my cost of acquisition, but there was an advance money forfeited case of 1,11,000 rupees. So that need to be reduced from my cost of acquisition. The remaining cost of acquisition would be 9,59,000. There was a cost of improvement also, 3,90,000. So after that, my long-term capital gain would be 2,500. And now we have to calculate tax upon this at the rate 12.5%. This is my GTI, this is my TI. No other information has been given in the question. So this is my TI, this is my GTI. So according to it, the tax on this value would be 315063. And after 4% cess, 12603, the tax would be 327,660 after rounding off. Now, this is the capital gain for the purpose of GTI and TI and tax. But for the purpose of tax calculation, now I have to calculate this capital gain with indexation benefit also. So sale consideration would remain the same. Expenses on transfer will remain the same. Now indexation would be applicable on my cost of acquisition. 9,59,000 into 363 upon 100. That would be 3481170. Then the cost of improvement also need to be indexed. 363,254. 557,362. So there would have been a loss. 169032 would be the loss. So there would not be any tax. And the very interesting thing, this loss cannot be carry forward also. No carry forward. Because this loss cannot be the part of your GTI. This is only for the purpose of your tax calculation. So we can say in this case, assessee not need to pay any tax because there would be a loss if we apply the indexation concept. So it is beneficial to the assessee to pay the tax after indexation. But this loss cannot be carried forward in any case. This loss would be only part of your tax calculation. Okay. Somebody wants to ask something. Mr. Chauhan wants to ask something. Okay, there's no query. Okay, Mr. Chauhan, what you want to ask? You raise your hand. Please go ahead. Can we unmute Mr. Chauhan?
हेलो सर। सर एग्जाम में हमें ये कैलकुलेशन करके दिखाना है कि इसकी एक्चुअल टैक्स लायबिलिटी 0 है।
हाँ बिल्कुल, of course. The question asked, calculate the tax liability on the basis of the capital gain income only. So you have to show this calculation that the tax as per the normal provision, if we do not apply the indexation, would be this much. But there would be a loss, so there could not be any tax liability if we apply the indexation concept. And you also have to write this thing that this loss is not a part of this loss. We cannot carry forward this loss also. And tax liability would be zero. We have to show this in the examination.
और सर जीटीआई में तो जो हमने पहले कैलकुलेशन किया वही लिखना है।
हाँ, जीटीआई में सिर्फ उसके अकॉर्डिंग आप एक टैक्स दिखाएंगे, जीटीआई के अकॉर्डिंग टैक्स विदाउट इंडेक्सेशन दिस वैल्यू। फिर आप नीचे दिखाएंगे इफ वी डू अप्लाई द इंडेक्सेशन कांसेप्ट देन देयर विल बी अ लॉस, सो देयर इज नो टैक्स। तो नीचे आप आंसर लिखेंगे उसके बाद कांसेप्ट में that there would not be any tax liability as there is no tax, there is no income after indexation concept. And please also write it down that this loss cannot be carried forward. This is only for tax calculation purpose.
Okay, thank you, sir.
Soumya is asking, sir, for tax calculation, we need to calculate LTCG with and without indexation. Yes, of course. Only for if the question asks you to calculate tax, then you only need to applicable this without indexation and with indexation. Because in normal case, you just need to apply the without indexation concept for calculation of GTI. If tax has been asked in the question, then only you will apply the indexation if the concept is applicable. Jayendra asking date of agreement and date of transfer in two different financial years. So generally the date of agreement, the provision under section 247 was there. If you've gone through in the definition of transfer, there's a point which says there, if it is a part performance, the provision says if there's a part performance, if you receive the possession and you have paid the compensation or consideration, in that case, we can treat it as a transfer. And in that scenario, in that previous financial year, you have to calculate the capital gain. So if there is a consideration and if there is possession, both condition has been satisfied, then in that year in which the both condition has been fulfilled, we have to calculate the capital gain. So please go through with the definition of 247. I have explained this concept with example also. Mr. Anil Singh, sir, in last question, how can assessee go for two options? Because there is a concept, Anil, there is a benefit which has been given by the department. In the capital gain provision, we have discussed that concept, that if there is an individual HUF resident in India, and if they transfer immovable property, so government has given the two benefits. Either you are able to pay tax without indexation at the rate of 12.5%. Or you can pay tax with indexation, but at the rate of 20%. So that is the power has been given by the law. That's why we can apply two options. Any else query, students? Soumya is asking, sir, for GTI calculation always, we need to calculate capital gain without indexation. Yes, always. For the purpose of GTI, we always need to calculate the capital gain without indexation. There would not be any indexation concept if you are going to calculate tax according to GTI without indexation. Okay. Until otherwise the question asks you to calculate the tax, you are not going to apply the indexation concept. There are some MCQ from income from other source. I want to discuss those MCQ with you. And you have to answer those questions, students. I will upload the answer. Okay. So first answer I already been marked. Okay, from question number 2, we are going to solve these MCQ. Kindly read this and send me your answer. Rakesh acquired an air condition for 3 lakh from his friend and non-relative. When FMV of the air condition was 5 lakh, what is the amount of taxability? Very simple question, of course. Nil. Okay, Soumya is saying 2 lakh. Very good. Harshada is saying 3 lakh. Brilliant. Nidhi is saying nil. Rajveer is saying 50,000. Very good. Sunil is saying nil. Very nice. So what I have asked you all, that when you try to solve a question of income from other source, gift case scenario, what you need to check firstly, what I have asked you, student, you have to check that whether that asset does fall in the definition or not. We are talking about air condition. So does air condition fall in those non-monetary asset we have discussed under income from other source or not? Can you please think about it? Does air condition fall in those asset we have discussed in income from other source for the purpose of taxability? No. So it is not applicable case. There is not a capital asset. So why you are going to tax it? Arshada is taxed it. Soumya is taxing it. Astha is taxing it. Why? First of all, you have to find it out whether this asset does fall in that category or not. That is very important to see. Without that, there could be a lot of problem in this case. Okay. Next question. ABC transferred a residential house held as stock in trade. What is the correct answer, students? Let's see. सेकंड का आंसर अभी तो बताया. सेकंड का आंसर होगा नील. I will upload this with answer sheet. Do not worry. Second का आंसर नील होगा. Okay. So what the answer was third? The third correct answer is of course 2 lakh rupees. Because the difference is 2 lakh rupees. And if in case of income from other source, we have to see the difference between the stamp duty value and the consideration. It is 2 lakh rupees. Now we have to compare it with, it should exceed 50,000 or 10% of consideration, which is 1,50,000 in this case, whichever is higher. So if the difference between stamp duty value and the consideration exceeding the higher of this value, then this difference of 2 lakh is going to be your income from other source. So in this case, the correct answer would be B. Next. Question number 4. Let me see. Ishan is saying D. Chauhan Tej Prakash saying D. Very good. Nidhi is saying D or nil. Correct. The correct answer is nil because in this case, stamp duty value does not exceed the consideration. So if stamp duty value does not exceed the consideration, then there would not be any income from other source. Well done. Next question. ABC transferred a residential house held as stock in trade in books by way of first time allotment to Mr. Ankit for a consideration of 15 lakh. The stamp duty value was 19 lakh in this case. So it's again very simple because the stamp duty value exceeding, and if it is exceeding by 50,000 or 10% of consideration, then the difference is going to be your income from other source. So in this case, that would be 4 lakh rupees. Next. A lady received gifts worth 1 lakh from her relatives as defined under the Income Tax Act and 60,000 from her office colleague on her marriage anniversary. You have to tell the taxable amount of gifts. How much would be the taxable amount of gift in this case? Somebody is saying 160. Gift from relative is exempted always. Why Nidhi is saying 160? Rajveer is saying 160. Why students? Why? Gift from relative is always exempt. So this is going to be exempted. But gift from friend on anniversary is going to be taxed. So the correct answer would be B. Why you are saying 1,60,000? It's very simple question. Next is Mr. A received old coins worth 1 lakh as gift from his friend on 20th April 2024, for which his friend charged 25,000. The taxable amount in the hands of Mr. A would be how much? Correct answer would be, why Ishan is saying nil? Why nil? It's 75,000. It's inadequate consideration. So the answer would be 75,000. Next is Akshay received a gift check of 35,000 each on 22nd May 2024 from his two friends. The amount chargeable to tax in this case would be, how much would be the amount chargeable to tax in the hands of Mr. Akshay? The correct answer, of course, 70,000. Very simple question I'm asking to all of you. Richa received gift of jewelry FMV of which is 3 lakh on 17th October from her fiance. What will be the taxable amount? Fiance or fiance? So what is going to be the taxable amount in this case? Read carefully. 3 lakh is saying, Anil is saying nil. Jayendra is saying 3 lakh. Vemuri Janvi is saying nil. Astha is saying B. Chauhan Tejveer is saying B. Why Anil is saying nil? Why Anil? It should be nil. Why? Fiance is not a relative. Relative would be after marriage. So fiance would be considered as stranger. And if you receive any gift from a stranger exceeding that much amount, and that does fall in the definition of non-monetary item, this is going to be tax. So the correct answer would be 3 lakh rupees. It does not fall in the definition of relative until the marriage happens. Next is Mohan received a watch worth 60,000 from his cousin grandfather, brother of his grandfather. So you have to see whether it does fall in the definition of relative or not. Then according to it, you have to answer. So what is the correct answer of question number 10? $60,000 Anubhav is saying, Pooja is saying nil, Anil is saying nil, Astha is saying 60,000. What happened, Astha? Wrong answer. It could not be 60,000. Chauhan also saying 60,000. Tej, what are you answering? Shagufta is also saying 60,000. Harshada is also saying 60,000. Ishan is also saying 60,000. What are you saying? I have asked you multiple times, students. I intentionally asked you that you have to see whether he is a relative or not. So the answer is he's not a relative. That's why you did not check this thing, what the asset I am talking. You just focus your answer on this condition and you skip the question completely. I am talking about a watch, and watch does not fall in the non-monetary asset. So kindly watch what has been written in the question. You did not watch it. That's why you're going to lose this kind of question. So because it does not fall in the nature of the asset, so the answer would be A. Relationship does not matter. First of all, you have to find out which asset we are talking about. Okay. Next is on 30th June 24. Raju get gifts by a commercial flat from the elder brother of his father-in-law. Stamp duty value is 25 lakh. The amount chargeable to tax in the hands of Mr. Raju is. How much would be the amount in the hands of Mr. Raju? Old coin is antique thing. Archaeological collection, that is kind of thing. We called it archaeological collection, Ishan. That's why we have included it. Okay. That's why it's not nil. It's old coin. I have told you now. What is archaeological collection? Antique things, which is having higher value like drawings, painting, etc. So correct answer is 25 lakh rupees of this. Okay, so the other questions I will upload it on the portal. You can go through with it. And if any problem, you can ask me in the next class. Now we will have our next class on Tuesday, in which we will discuss the provisions of clubbing, income of another person, including the another person category. So the clubbing provision we will discuss, and after that there is a concept of set-off of losses, what we are going to discuss. So that is going to be discussed later. Any other query you can ask me. How write in exam final answer. So how you need to answer your question in examination, that will be discussed when I will take your last class. That would be after TDS, return filing, and computation of your tax liability. In that class, I would make you understand how to write your questions. Any other question? Jayendra is asking page number 3.438 CBDT circular number. Okay, let me see, Jayendra, what you are asking. I have to open the study material. 3.438. Let me see. In the event of death of an individual before the stipulated period, the unutilized amount is not chargeable to tax in the hands of the legal heir of the deceased individual. Such unutilized amount is not income, but it is a part of the state developing upon them. So that provision we have discussed. In case of life insurance premium payment case, or okay, it's not that, it's about capital gain. So the provision was saying if the CGAS amount is not utilized within the stipulated time. So the basic provision in that case was, if the amount we have deposited under CGAS account, and if it has not been utilized within a certain time, that the amount is going to be taxed. But in your case, the CBDT says that if suppose the assessee has been passed away, and that unutilized amount has been received by the legal heir, so that would not be taxed in his hand. That will be become that legal heir property. State means that will become his property. So if anything has been earned from that income in future, that is going to be taxed. But the amount unutilized would not be taxed if the assessee has been died in that CGS scheme. Okay. No, sir, my doubt is over. Which doubt you have? In this question with index, if tax greater than without index, then what is your question, Chauhan Tej Prakash? In this question, which question you're talking about? In this question with index, the question number 7 we have discussed, and test your knowledge question, you're talking about that? Okay, I have explained you the way I solved that question for you. First of all, you have to calculate your GTI without index and calculate tax at the rate 12.5%. Then after that, you have to write it down that now we are going to calculate tax after applying the indexation concept, and you have to solve it with indexation. Then you will get your capital loss. There would not be any capital gain. There would be capital loss. So after that capital loss, you can write it down that if we opt for index cost of acquisition, there would not be any tax liability. So this is beneficial that assessee will apply the indexation benefit. But this loss we cannot carry forward. If you want to see how to write an exam, so after the test and knowledge question, the solution has been written after this provision. You can go through with the solution part. You can see how the institute has defined or drafted to write that answer. Let me show you. You can see the solution is there. Institute recommended solution. And you can see how they have solved question number 7. So you will come to know how to present the answer as follows. You have to solve this question like this. You will have the gain. Now you are going for the tax liability in section 112, the tax according to without indexation. And then you can see after the indexation concept, you will find out the loss. And now like this, you can show that we are going to not applicable the normal provision. We are going to apply the indexation concept, and that will not result in gain. That will result in loss. So we are not liable to pay any tax. Jayendra asking, chapter 6A deduction available to other income only. Is this statement correct? Yes, absolutely correct, Mr. Jayendra. We have discussed this concept also under capital gain. And you might have missed the last class of capital gain, in which I have show this concept with the help of chart also. So you can go through and see the capital gain last class, and your all doubt would be clear regarding deduction concept. Chauhan is asking, if there is no loss gain within DAX, it possible? If there is no, there could be zero, could also be the answer. If your sale consideration and DAX cost of acquisition is equal, so that could be a zero. That is possible. Jayendra asking, section 58(2) disallows cash payment rupees 10,000 to every SSE, increase limit of 35,000 limit for disallowance for transport operator, plying, hiring, leasing, correct? Yes, absolutely correct. This must have been discussed also in PGBP also. You might have gone through with this provision. It's the correct answer. Anything else? Jayendra is asking, in casual income, expenses incurred shall be allowed in respect of activity of owning and maintaining such horses, such loss allowed to carry forward. Let me correct you, Mr. Jayendra. Owning and maintaining race horse is not a casual income. Okay, it is not a casual income. It's the person who is owning and maintaining racehorse. If I am going to bet upon that race in which his horse is running, that is winning is my casual income. But the person who is maintaining the owning and maintaining race horses, so if he earned any income or reward, that is not his casual income, that is his normal income. So any expenditure he incurred on maintenance of those horses, etc., that is going to be allowed to be deductible as a business activity. But that has not been treated as proper business. So income tax has been included that owning and maintaining racehorses as an income from other source cases. But you can claim the expenses for that activity. That would not be your casual income. And if there is loss, yes, that loss can be carried forward and set off also against the same head of income. And how that loss can be carried forward, etc. What is the time limit? 4 years the time limit. We are going to discuss that in set off of losses chapter. But that is not a casual income. Okay. If assessee not claim deduction under section 80 double D relative handicap, then liability not arise. Yes, in case of death, if you receive the amount, that tax liability would not arise. In previous year 33-34 1 LIP under section 1010D, exemption claim premium 2 lakh. Previous year 34-35 1 LIP, exemption not claimed. Premium 2 lakh, 35-36 1 LIP, premium 3 lakh. Should we consider 34-35 for 5 lakh calculation purpose? Previous year 34-35 1 LIP under section 1010D, exemption claimed. You have claimed the exemption in 33-34 and premium was 2 lakh. In previous year 34-35 1 LIP, exemption not claimed, premium 2 lakh rupees. And previous year 35-36 1 LIP, premium 3 lakh. Should we consider 34-35 for 5 lakh calculation purpose? You have to consider it. But the problem is this, whether 34-35 amount has been received in 35-36. You can only claim the accumulate the premium if the amount has been received from that policy. So if 34-35 amount has been received also in 35-36, then you can club that amount. So it will depend that you are receiving any sum from that maturity of that policy in 35-36 also. So I guess Manish ji, we can close the session now. Students, if you have any query, kindly wait for the next session because the time is already a lot has been passed on. So we will discuss those queries in the next session. So Manish ji, can we close the session? Thank you.